Welcome. In this video, Zbcn coin, what is the next move from here? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
In technical analysis, observing how price movements react at certain levels is extremely important for understanding the future direction of an asset. In this context, especially support levels are key technical indicators closely followed by investors and traders. A support line positioned just below the price can be a crucial building block to determine whether the current uptrend or sideways trend will continue. Such a support line acts like a springboard when the price is pushed downward, representing a critical point where buyers step in and the price can move upward again. Now let's examine the importance, function, and potential effects of this structure in detail. A support line in technical analysis is a horizontal or sloped line where the price pauses and often bounces upward while moving downwards. These lines have been observed as levels where the price previously stalled, buyers gathered strongly, and sellers' pressure decreased. Therefore, these levels are places where downward price movement may slow down or stop. If the price approaches this support line, investors usually become alert because a reaction buy is highly likely here. This means the price will bounce off the support and start a new upward wave. However, things don't always go as expected. If the price reaches this support line and fails to hold, meaning it breaks through the line, it creates a negative sentiment among investors. The breaking of the support line indicates that buyers no longer have enough strength at that level and sellers have become dominant. This leads to an acceleration of the decline or a deepening of the downtrend. Especially if the breakdown occurs with high volume, the decline may become even sharper because investors might rush to close their positions by selling. This can push the price down to lower levels. The price touching and bouncing off the support line is often a sign of a bull market or at least a short-term recovery. Such a bounce is called a bounce in technical analysis. This bounce creates new buying opportunities. If volume increases during this bounce, it shows that buyers are strong and the market is preparing for an upward move. These kinds of scenarios are also advantageous in terms of risk-reward ratio. Because buying at the support level is done with a stop-loss level close by, the potential loss is minimized. However, if the support line breaks, the investor must apply stop-loss in a disciplined manner, because the broken support may turn into resistance. This is known as support-resistance flip in technical analysis. After this flip, even if the price rises back to this level, it becomes a difficult barrier to overcome. Therefore, positions that do not cut losses in time can suffer greater losses. Now, let's make this more concrete with a scenario. Suppose an asset is trading at $0.05 and there is a strong support line at $0.048. This support line has been tested several times in previous price movements, and each time the price responded upwards from here. This creates a perception among investors that this level is a strong support. If the price approaches this level again, many traders may prefer to buy here. This causes the price to bounce upward and the support line to work again. But if the scenario reverses and the price breaks the support, investor psychology is disrupted because the support that has worked many times before is no longer functioning. This may cause investors to panic, close positions, and trigger new sell orders. As a result, the downtrend accelerates further. Such breakdowns are commonly referred to as breakdown in technical analysis. After such a breakdown, the price searches for a new support level. This means entering an area that has not been tested before and where it is not yet known at which level buyers will step in again. This uncertainty prevents new investors from entering the market and causes existing investors to act cautiously. From a technical analysis perspective, these uncertain situations usually lead to sideways or choppy price movements. Of course, all these scenarios are based on probabilities. Technical analysis never provides 100% certainty. However, support and resistance levels are among the most accurate technical tools based on past data. Therefore, the existence of a support line means both opportunity and risk for investors. If this line is analyzed correctly and price behavior is closely monitored, investors can make trades in their favor. Otherwise, breaking the line can inevitably lead to increased losses. Finally, the strength of support lines varies according to how many times they have been tested. The more a support has been tested, the stronger it is. But at the same time, repeated tests can also weaken the line, because with each test, the number of buyers trading at that level decreases and the level becomes more likely to break. Therefore, the older and more frequently tested a support line is, the more carefully it should be analyzed. In summary, a support line located just below the price is a very important structure that can influence market behavior. When the price approaches this line, the direction of the movement that occurs here is very important. If the price bounces off this level and continues upward, it is a positive signal for investors. But if the support line breaks, the downtrend deepens and the possibility of seeing new lows increases. For this reason, these technical levels are not just simple lines drawn on a chart, but are vital technical indicators where market psychology and investor behavior concentrate. When analyzed correctly, they can offer great opportunities, but when neglected, they can cause serious losses. These structures should always be considered as a key component in every investor's analysis process, but we can't decide solely based on support. Let's look at other metrics. Stay tuned.
A bearish order block located just above the price is considered a very critical structure in technical analysis. This type of structure represents an area where the price previously rose to a certain level and then faced strong selling pressure, meaning it encountered significant supply. In the current situation, this bearish order block positioned just above the price is a region where sell orders were concentrated in the past and buyers lost strength. Since this area represents a level where investors previously sold and large players drew liquidity, how the price reacts when it reaches this level again is of great importance. If the price rises to this bearish order block and is not rejected, meaning it breaks above the block and holds there, this is considered a very positive signal for the continuation of the upward trend, because the bearish order block acts like the last stronghold of selling pressure. When the price manages to surpass this level, it means that the liquidity above this level has been absorbed by buyers, and the sellers who had previously exerted pressure are no longer actively involved or have closed their positions. This situation directly aligns with the breakout and retest concept in technical analysis. If the price reaches the area marked as the bearish order block and closes a candle above this region, then this area has the potential to turn from resistance into support. This indicates a shift in the psychological thresholds in the market and shows that investors have gained more confidence in the upward movement. Breaking through the bearish order block is often a reevaluation opportunity, not only for short-term traders, but also for medium and long-term investors, because the breaking of this area signals an increase in upward momentum in the market structure, which accelerates the entry of new buyers into the market. Additionally, the price breaking above the bearish order block usually means reaching a higher liquidity level. This can attract larger investors known as whales, because large investors typically prefer to enter the market after such structural breakouts. The main reason is that risk becomes more manageable at these points. Price movement above the bearish order block can also be the initial signal of large moves known as stop hunting, where small investors' short positions are liquidated. Another important point to pay attention to is how the price approaches this bearish order block. If the price approaches the block with low volume and weak candles, the probability of rejection at this region increases. However, a price move with strong volume and long green candles raises the likelihood of the block being broken, because market participants associate a strong price move approaching the block with momentum and tend to follow that momentum. Breaking the bearish order block can technically confirm an uptrend. This breakout usually signals the start of a new structure and that the trend will continue higher. Because the price surpassing this region shows that demand has become dominant in the supply-demand balance, and buyers in the market are now stronger than sellers. This generally leads to more stable and sustainable upward moves. Also, after breaking such order blocks, it is considered healthy technical practice for the price to return and retest the area. This is called break and retest. That is, the price breaks above the block, then pulls back slightly to test the region. This test is very important for new buyers to enter and for sellers to turn into buyers again. If the price reacts without falling below this region during the retest, it confirms the upward trend. This structure gives investors great confidence and provides an opportunity to open new long positions. The logic behind order blocks is that institutional investors have left large buy and sell orders in these regions. Therefore, these areas are much stronger than ordinary support or resistance levels, because there is a past imbalance that occurred here. In the bearish order block, significant selling pressure formed in the past, but now the price is approaching the same area again. If sellers fail to hold and the price continues upward, it shows that the side that previously disrupted the balance has lost control. This means the market is moving to a new balance, which usually includes higher price levels. Especially when evaluated from an investor psychology perspective, breaking such structures creates great relief in the market, because for investors, these order blocks are like a test. When the price breaks above this region, many investors say, yes, the uptrend is starting now, in open positions. This causes the price to move faster and upward momentum to increase. Some investors even develop buying strategies solely based on breaking this block. This strategy is preferred because it generally has a high risk-reward ratio, because when the block breaks, there is an expectation that the price will continue higher for some time. Also, there are usually liquidity pools just above these bearish order blocks. These regions are where stop orders accumulate and large moves are fueled. When the price breaks these blocks, it can trigger these liquidity pools and create sudden and sharp upward moves, which allows the price to show a significant increase in a very short time, because the market moves liquidity upward at that moment, producing a signal that unites both short-term and long-term investors. In conclusion, although a bearish order block located just above the price is considered a very strong resistance level in technical analysis, if the price breaks above this level, meaning breaks the block, this is a clear confirmation of an uptrend in the market. This breakout holds great importance not only technically but also psychologically and structurally. It means moving into a structure where sellers lose influence and buyers become dominant. Such a breakout usually accelerates the entry of new investors into the market, allows the price to advance upward with stronger steps, and completely turns the general market sentiment positive. Breaking the bearish order block is the confirmation of a trend start for many investors and a buy signal for many strategies. Therefore, passing above this block is not just a temporary rise, but can also be the sign of a long-term rally. The block must be broken or else no new high will form.
RSI, or the Relative Strength Index, is a highly valuable oscillator indicator frequently used in technical analysis and plays a major role in measuring the momentum of price movements. The RSI indicator typically ranges between 0 and 100, with the 50 level representing the neutral zone, values above 70 considered the overbought area, and below 30 indicating the oversold area. When RSI shows values near or at these limits, it suggests the price may be either overextended to the upside or downside. However, in some cases, trend lines can also be drawn on the RSI itself, and these trend lines provide very strong clues to anticipate price movements in advance. The most notable structure currently observed on the RSI indicator is a descending trend line. This descending trend line is formed by connecting the peaks of the RSI, creating a downward slope over time. This descending trend line is significant for investors because the RSI has touched this line multiple times, and each time upward momentum attempts have failed. The RSI repeatedly hitting and bouncing off this trend line demonstrates that it is a very strong resistance area. Such a structure may indicate that the price is struggling to gain upward momentum, and market sentiment has not yet shifted into positive territory. However, a breakout of this descending trendline by the RSI can be a sign of a potential upward move, because such breakouts generally indicate that the market is regaining momentum and investors are beginning to lean toward the bullish side. Breaking this descending trendline on the RSI is not just a technical signal, but it is also regarded as a strong indication that the market's direction may change. Especially if the RSI forms a new upward trend after breaking this line, this can positively reflect on price action as well. Because a breakout on the RSI shows that the price is gaining strength and may be more successful in overcoming previous resistances. Usually, an increase in volume can be observed immediately after this breakout, and this volume rise supports the price's upward movement. Therefore, the trendline breakout on the RSI is not only a change within the indicator itself, but also an early sign that a transformation may begin in the price structure, When the RSI breaks its descending trendline, the chance of a short-term upward attack in price increases significantly. Such descending trendlines are closely watched by investors because they are among the clearest signals that the price's current downward momentum is weakening and buyers are starting to re-enter. Especially if this descending trendline has held multiple times before and the RSI has bounced off it repeatedly, the breakup moment becomes an even stronger signal. When this breakout occurs, if the RSI value rises above the 50 level, it signals that positive momentum is strengthening further. Additionally, movement toward the 70 level suggests that the price is under strong buying pressure and an upward explosion may be imminent. The RSI not only breaks this descending trend, but if it also retests this trendline as support and then moves upward again, this can mark the beginning of a larger and more sustainable rally. For investors, breakouts of descending trends on the RSI usually coincide with resistance breakouts on the price chart. This is one of the best aspects of technical analysis. When different indicators confirm the same result, the analysis becomes more robust and reliable. If an important resistance is broken on the price chart along with the RSI's descending trendline breakout, this is technically called a double confirmation and creates an ideal environment for the start of an uptrend. In this context, breaking the descending trendline on the RSI is not only a structural change inside the indicator, but also a sign that overall market psychology is starting to shift. When the RSI breaks above this trendline, the price usually initiates an upward move as buyers begin gaining strength.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.